Hi, welcome to my channel on option. In this video, I will try to give you a simplified explanation of option trading basics and its terminologies. The terminologies what we are going to see is options contract, expiry date, spot and strike price, call option or a put option, open interest, OTM, ITM, ATM, implied volatility and options premium. Let's start with what is an option. Options are financial derivatives. These derivatives are based on the value of an underlying asset. Underlying assets are nothing but it can be a stock, it can be an index or a commodity, or it can be a bond or even a currency. Let's start with the basic terms: spot or strike price, what is lot size, what is expiry. Throughout this video, I will use Infosys stock and Infosys option as an example. So last traded price of Infosys stock on 12th June 2020 is 691 rupees. That is nothing but a spot price. If we look at Infosys options, you can trade in call option as well as in put option. You can buy, also you can sell, and you can do this trade in various prices. You can see the list here. These prices are known as strike price. If you are buying an Infosys stock, you can even buy one quantity, but same is not possible with options. Options has to be traded in a lot size. This lot size is defined by the exchange. It will vary stock to stock. Same way, strike price distance also will vary stock to stock. For example, for Infosys, lot size is 1200 quantity. If you want to trade an option, you have to buy a minimum of one lot size. Let's see what is an options contract. Options contract is a contract between two parties to exchange an underlying stock at a specified price by a specified date. In this case here, underlying stock is nothing but an Infosys stock. Here we are talking about an options contract, but the contract talks about an underlying stock, which is an Infi stock here. And the price at which the contract has been made is nothing but a strike price, what we see it here. You can make a contract on any of the available strike price. What is expiry? When you buy a stock, you can keep it as long as you want and as long as it is being traded on an exchange. But in the case of options, you cannot do the same. Options contracts have a defined end date, that is known as an expiry date. For example, in National Stock Exchange, all stocks have expiry on last Thursday of every month. If you take Nifty or Bank Nifty index, they have expiry on Thursday of every week. Now let's jump into call options. What is call option? Let's try to relate to a practical life example. Let's assume a person called S. He is a building contractor. He is constructing an apartment. Current market value of that apartment is 1 crore. But he is foreseeing that there is a metro station coming up nearby. So this apartment value would easily rise to 1.1 crore. There is a person called B. He is looking to buy an apartment in the same city. He comes to know about this apartment. Also, he knows about that there is a metro station coming up nearby. So he discussed with this person S, and he made an agreement that he would be paying a 5 lakh rupees as an agreement to buy this apartment in 3 months time. So let's take a case here. After 3 months, what happens? So now they made an agreement for 5 lakh rupees so that the buyer would buy this apartment within 3 months time. Let's take two cases here. Assume the metro station did not come up as expected. So the apartment value has gone down drastically to 0.9 crore. In this case, the person B can walk away. He may not buy that apartment because the value is already drastically down. So he would be losing this 5 lakh rupees what he paid as a contract fees. The seller S retains 5 lakh. He also retains a flat. He may find another buyer to get a good price. Let's take a scenario 2. In case the apartment value has gone up to 1.2 crore, maybe the reason could be that the metro station work has been completed before its scheduled time. So the apartment price has shot up to 1.2 crore. In this case, B would be very happy to exercise his contract. That means he will buy the flat, but he would get it at 1.1 crore because the agreement price was 1.1 crore here. So the person is supposed to sell the flat to B at agreed price. So this is a real-time scenario. Same can be related directly to an options contract or options trading. So the person S can be related to an option seller the person B can be an option buyer. And the contract what we make is something similar to a call option contract. The money what he pays is a premium amount, options premium. And the current market value of the apartment can be related to spot price. And the future or anticipated price is known as strike price. The agreement validity is known as expiry. Now let's see how a real-time call option trading happens. Let's see with one example. So before moving on to the real-time example, let's have a theoretical explanation about the call option. In a call option, buyer has the right to buy the stock at a specified price by a specified date. In similar way, seller has the obligation to sell the stock at the strike price if buyer exercises the option. Let's see a quick look at INFI options table. So the right side what you see is the different strike prices available, and this one is last traded price as on 12th June, right? This is nothing but a premium for one quantity. Now let's take a quick view on the real trading. Assume INFI stock is trading at 690 rupees. Option buyer is expecting that INFI would go easily above 720 in a month. So he would go and buy INFI June month expiry 720 call option. He has to pay a premium of that particular contract at what price it is trading. The option seller, he would have speculated that it won't go above 720. That's the reason he opted to sell this contract. He sold this contract, the same has been bought by this option buyer. So whatever premium buyer has paid, the same has been collected by the seller. Now let's see what happens on the expiry date. So on expiry date, let's take a scenario 1. Assume INFI stock is trading at 750 rupees. In this case, option buyer's expectation has become true. So he expected that it would go above 720. So now it is trading at 750. So he can decide to exercise his contract. That means he has the right to buy the stock at the specified price. That means he had bought the contract of 720. So he can buy INFI stocks at 720 rupees. But remember, INFI stock is trading at 750 rupees. So that means he gets this 30 rupees profit immediately. What happens to seller in this case? Seller must sell INFI stocks to the buyer at 720 rupees. So in this case, seller would be losing immediately 30 rupees. He has to buy it from the market at 750 rupees and sell it at 720 rupees to the buyer. I hope this scenario 1 is clear. Let's move on to scenario 2. In case if INFI is trading at 650 rupees on the expiry day. So this is against the option buyer's expectation, but in line with option seller's speculation, right? So in this case, the contract expires worthless. So buyer loses all the premium what he paid. But option seller, he gains all the premium what he had collected. So these are the two different scenarios in a call options contract. Now let's look at put options. Again here I would like to tell you a practical example, and then we move on to the real-time put option trading. There is a person called S. He owns an insurance company. There is a person B. He owns a car. He wanted to take an insurance for his car. He wanted to insure the car for 5 lakh rupees. And he makes a 10,000 rupees premium to the insurance company, and he make a contract with the insurance company. The contract validity is 1 year. Now let's look at two different scenarios. Throughout the year, he hasn't made any insurance claim. In this case, what happens? Contract becomes worthless at the end of the year. The person B loses all the premium what he paid, but the company, the insurance company or person S keeps all the premium what he collected. Let's take the second scenario. Car has been stolen, or it has met with an accident and got into full damage. So B exercised the option. That means he claims the insurance and he gets this insured value of full 5 lakh rupees. So insurance company loses all the 5 lakh, but insurance company does many such contract with many other car owners. So they earn with the other contracts. Those expired worthless, means where there was no claims made. So the company makes a profit with that. This can be easily related to a put option trading. So in this case, insurance company is an option seller or a writer, and the car owner is an option buyer, and insurance is nothing but a put option contract, and the money what he paid for an 1-year insurance premium is option premium, and the insured value can be directly related to the strike price, and the validity of the insurance can be related to the expiry of the option contract. Now let's see one practical option trading scenario. Let's take the example on INFI again. It's straight opposite to the call option. In call option, if you remember, buyer has the right to buy, but here in put option, buyer has the right to sell the stock, sell the underlying stock at the specified price by a specified date. Seller has the obligation to buy the underlying stock at the strike price if buyer exercises the option. Take a look at the options table. So these are the different strike prices available, different premiums available on that particular date, 12th June. So INFI is trading at same 690 rupees on 12th June. So what does option buyer expects? He expects that INFI would go below 680 in a month. That is his expectation. So what he does, he goes and buy this INFI June month 680 put option contract. He buys this contract by paying this premium for one quantity. I hope you remember I mentioned that option contract can be traded only as slots. He would be buying this option contract at this premium for 1200 quantity. What does option seller is thinking when this contract has been made? He speculates that it won't go below 680. He speculates just opposite to the buyer's expectation. So that's the reason he decided to sell this contract. Sell INFI June 680 PE contract he sold. When option buyer buys this contract, he paid a certain premium as we had seen here. The same premium has been collected by the seller. Now let's see two different scenarios on the expiry date. On expiry day, INFI is trading around 650 rupees. That is as per the option buyer's expectation. So he decides to exercise his contract. So he has right to sell the underlying stocks, Infosys stocks at 680 rupees, even though the INFI is currently trading at 650. Option buyer gains. So in case of option seller, he has the obligation to buy Infosys stocks at 680 from the option buyer, even though the current price is 650, which is lower than the agreed price. Option seller must have to buy this Infosys stocks from option buyer at 680 rupees. That is the loss to option seller because he is buying at a higher price than current market price. Let's look at the scenario 2. On expiry day, let's say INFI is trading at 750 rupees. This is straight against the expectation of option buyer. In this case, the option contract expires worthless. So the buyer loses all the premium what he paid. Option seller gains all the premium because his expectation has become true. He speculates that it won't go below 680. The same way INFI is trading at 750, so he gains all the premium what he had collected. Let us see one more practical use case of a put option. There is a buyer B. He invested 9.6 lakh rupees in Infosys stock by buying 1200 quantities at 800 rupees in the month of January 2020. But in the month of March, the markets were in the downtrend due to this COVID-19. So he decides to protect his investment. He is ready to pay 1% of his investment value as a protection money. So he decides to buy one lot of INFI put option from a seller. So on 2nd of March, INFI was trading around 740 rupees. Option buyer expects that INFI would go less than 618 in a month due to this COVID-19. So he decides to buy INFI March 680 put contract at 7.5 rupees premium, and he bought one lot. Option seller speculates that it won't go below 680. That's the reason he sold the same contract to this buyer. But he collects the premium whatever has been paid by this option buyer. Now let's see two different scenarios here. One we see 3 days before expiry, that is on 23rd of March. INFI was trading around 526. This is too lower than his expectation. So what happened to his investment? His investment has gone drastically down. He invested 9.6 lakh rupees in the stocks. Now his stock investment value is 5.26 lakhs only. But Fortunately, what he did, he bought a put contract at 680 strike price. So in case if he decides to sell this put contract to someone else, what happens to that? That 680 put contract is currently trading at 149 rupees on 23rd March. So if he decides to sell, he can collect this 149 premium. He paid only 7.5 rupees to buy this contract. Now the same contract is being traded around 149 rupees. So he can easily gain 1.7 lakh rupees by selling this contract to someone else. So he can offset his portfolio loss. What happens to option seller? If option seller buys back this contract because it had gone completely against his speculation, he has to close the contract. So if he decides to buy this contract, then he would be losing this 1.7 lakhs on 23rd March. Suppose they did not close this contract, buyer waited until expiry. On the day of expiry, Infi was trading around 643 rupees. So which is still according to his expectation, that is less than 680 rupees. So in this case, the buyer can decide to exercise his PE contract. So that means he has right to sell Infi stocks at 680 rupees. He already holds 1200 stocks. He has the right to sell these stocks at 680 rupees even though the current market price is 643. So he can minimize his loss because he is able to sell now at 680, higher than the current market price. What happens to seller? Seller has an obligation to buy the stock at 680 rupees even though the current price is 643 rupees. So he would be losing this difference in price. So let's move on to the other terms used in option trading. Let's see what is moneyness of options. So what is out the money, OTM? All the call option strikes above underlying price. Right now underlying price is 691 rupees as on 12th June. So all the strikes above underlying price in call option is known as out the money strikes. Same way in put option, all the put strikes below underlying price is known as out the money strikes in put option. What is in the money strikes? In call option, all the call option strikes below underlying price is known as in the money strikes. Same way, all the put option strikes above underlying price is known as in the money strikes. What is at the money strike? Be it a call or a put option, whatever strikes closer to underlying price. Right now underlying price is 691. Whatever strike is closer to underlying, be it a put or call option, is known as at the money strike. I hope this is clear. Now let's move on to open interest. Open interest is nothing but total number of outstanding or active contracts. What is change in OA? Change in OA or change in open interest is measured on a given date. The number of new contracts created or closed in a particular day is known as change in OA. Both open interest and change in open interest is measured in terms of lot sizes. But when you take a volume is nothing but on a particular day how many number of transactions happened. That is known as volume on a given date. This is measured in absolute numbers, not in lot sizes. Let's see with some visual explanation. There is a seller who is creating a new options contract on day 1, and there was a new buyer, he bought the same contract. So one contract has been created newly on day 1. So in this case, there is an active contract on day 1. So the open interest is one lot. Change in open interest is also one lot because on this day 1 new contract has been created. Let's assume on day 2 the buyer B1 has sold this existing contract to another buyer B2. Remember, it's an existing contract, it's not a new contract. So in this case, volume is 1 on day 2 because there is one transaction happened. Open interest still has one lot because there is an outstanding contract. This contract is in active state, it has not been closed. Change in OA is 0 because there is no new contracts added nor contract has been closed. So that's the reason change in open interest is 0. On the same day, buyer B2 has sold it to another buyer B3. the same existing contract. So in this case, on day 2, volume becomes 2 because there are 2 transactions happened on a day 2. So that's why volume becomes 2. Open interest remains as 1 lot because this contract is still active. This contract has not been closed. Change in open interest is 0 because there is no new contract added on the day 2 or this contract has not been closed. So change in open interest remains as 0. Let's assume on day 3, first seller has bought this contract back from B3. So this contract is closed now. In this case, on day 3, there is no active or outstanding contract. So open interest becomes 0. Change in open interest becomes minus 1 lot. The reason being that there is an existing contract has been closed. So it has been indicated by minus 1 lot size. Just a note again to highlight, the change in open interest and open interest is always represented by its lot size, but volume is always represented as a number of transactions. Let me move on to the last term, implied volatility and option premium. Implied volatility indicates the expected movement of an underlying asset over the life of an option. High implied volatility results in options with higher premiums and vice versa. In a bearish market, implied volatility increases, and in a bullish market, the implied volatility decreases. Option premium is primarily based on 2 values. One is time value, other one is intrinsic value. Time value depends on strike price, stock price, expiry date and interest rates. Intrinsic value is nothing but an option's inherent value or its original value. We can say it has an intrinsic value if the option strike is in the money. When it is out of the money, its intrinsic value is 0. For example, if Infi is trading at 690 rupees, that's nothing but a spot price. Intrinsic value of an Infi 680 option, call option, 680 is in the money. So intrinsic value of Infi 680 call option is 10. That is nothing but if you subtract spot price minus strike price, you will get the intrinsic value. At last, I would like all viewers to note a couple of things which is very important. So option speculation allows all the traders to hold a leveraged position in an underlying asset at lower cost than buying it and holding it. Investors will buy PE contracts to hedge or reduce risk of their portfolio. Investors sell PE contracts to invest only at a specified lower price than the current market price. Investors buy CE contracts to invest at a specified price even its future price is expected to be higher. Investors sell CE contracts to get additional income even if the underlying is not moving up. These are just some things to remember. Let me give you a quick recap of what we had gone through until now. This is a NSE option chain main window. So what we had seen is what is spot price, expiry date, strike price, open interest, change in open interest, volume, implied volatility, call option, put option of course, then in the money, out the money, at the money. So all these things we had covered. So pretty much we covered all the basic terminologies used in options trading. Thank you for watching. If you aren't able to follow the content and have any feedback, please feel free to add it into the comment section. Don't forget to like the video and subscribe the channel.